Our next speaker is Anthony Doyle from Fidelity International. I interviewed Anthony on the Switzer podcast on Monday. And funny enough, Anthony, both you and I didn't pick this stock market problem this week. What happened there? Please welcome Anthony to the stage.
Thank you very much, and good morning, everyone. So I am one person in the room that gets up as early as Peter. 5:30 every morning, my 3-year-old boy stands next to the bed pointing at his mouth saying, "Wheat Bix, Wheat Bix." So I have 3 kids under 3, and today's a big day for me. It's my birthday. Oh, thank you. I know this is being filmed, so I want to show my wife after. But the grandparents came around last night with a cake, and I went home early, got the kids bathed in their pajamas. Twins are 18 months old, so we got them into the cot. But the young lad, 3 and a half now, very excited to sing happy birthday, blow out the candles. Mum comes in the door, first thing she does, gives him a gingerbread man. Okay, it's a bit late for that sort of sugar, Mum, but no worries, you're the grandmother, you can spoil him. Then comes the chocolate sponge cake. He gets a slice of that. It's about 7:30 at night, normally goes to bed at 7. Then comes the lemon meringue cake with all the meringue on the top. He gets a big slice of that. So he's amped up, he's full of sugar, and he's wheeling around the house, and the last thing we want is for him to wake up the twins. Very hard to get down. I don't want them to kick off. So my wife's looking at me with one of those looks that only a wife can give when your parents have come over and ramped up your 3-year-old son and given him a whole heap of sugar after a long day. My wife, she stays at home, looks after the kids. She's been with them all day long. Just get him to bed. I said, okay, I've got this. We get him into bed, and I pull out this presentation. He was fast asleep within 3 minutes. Now, the reason my young son and my kids should be interested in this presentation is because in terms of my savings plan for them, I've got a big bill of school fees coming up in about 12 years, and I'm putting it all into this asset class. The reason is it's a high growth asset class, it's a high returning asset class. You experience more risk. There's no returns without risk. However, I have a long-term time horizon. So today, I'm going to focus on the emerging market arena. For those of you that aren't aware of who Fidelity International is, we're one of the largest investment managers in the world. We have offices based globally. I was in Shanghai last week. I was in Hong Kong last week. We've been in Sydney for 15 years. We run Australian equity portfolios out of Sydney. You might be aware of the Fidelity Australia Equities Fund run by Paul Taylor. We have analysts here, have 120 analysts scattered around the globe looking for the best opportunities and the best companies that we can invest in. Our main investment hub for the emerging markets is in Hong Kong, but we're also onshore China in Shanghai. So I met with our China portfolio manager on the equity side and also the fixed income side. And what I want to talk about today is the big structural trends that are undergoing within emerging markets. I would advocate that every investor in this room, of course I can't give advice, but I would advocate that everyone should have a structural allocation to emerging markets. I would never say put 100% of your wealth in this type of asset class. It is a riskier type of asset class, but it's where all the growth is going to come from in the next decade and beyond. And there are some fantastic opportunities that are being presented to investors such as ourselves. Now, you may not be aware, but emerging markets as a proportion of the total global economy are actually over 50% today, and that's going to grow over the course of the next few years and continue to grow. So emerging markets are the biggest slice of the pie in terms of global economic growth. And their contribution to global economic growth is really what's driven the global economy over the course of the last decade, particularly since the GFC. However, if you look at a global equity index, emerging markets still a very small proportion of that index at only 11%. So despite being over 50% of global GDP, the emerging market equity component of a global equity index still very low. Now, I expect this to grow over time as these economies expand, but also as companies within these economies grow larger and you start to see valuations increase in countries like China, India, Indonesia, Brazil, Russia. Now, the IMF, in terms of their forecasts, they expect anemic, trend-like growth from the developed world of around about 2%. Now, what I think is really exciting is over 4.5%, close to 5% growth in emerging markets, but really driven by a combination of business investment, but also those orange bars, consumption. The rising wealth of the consumer in emerging markets that will start to enjoy and get close to a lifestyle and a standard of living that we enjoy here in the developed world. That will continue over multiple decades. So this orange component, consumption growth, that's really what drives the global economy today. It's what drives an economy like Australia, 60% of our GDP. It's what drives an economy like the US, 70% of GDP. So what we're looking at are these companies that can benefit from these long-term growth cycles and growth drivers. Now, of course, GDP growth is really a factor, or really driven by a factor of two things. One is productivity growth, and the other is really population growth. It's why Australia has enjoyed a fantastic run of over 30 years without a recession. It's because Australia is a great place to live. I've just returned after 12 years in London and Dublin, and there's no place like it. It is the best country in the world. You know, better than the US, I would tell Donald Trump. Forget about making America great again. Australia's already there. But people want to live here, and that's why we have net migration in. And as people come to Australia, and as they become employed, they start to earn a wage, they start to earn an income, they start to consume, and that contributes to GDP growth. The same is happening in the emerging markets. As you start to see the workforce expand, kids leave school and enter the workforce, start to earn an income, they start to consume, and they start to deliver on that consumption growth that the IMF continues to expect will drive global growth going forward. Now, in terms of today's population, the global population, 8 billion, 7 billion live in the emerging markets. You're talking about the law of large numbers, and that's going to continue to expand according to UN projections. Now, looking at per capita income, the income growth for the average person within these economies, for an economy like China, the average Chinese citizen is 10 times wealthier, or is estimated to be 10 times wealthier in 2024 than they were in the year 2000. For Aussies, we're about twice as wealthy as we were in the year 2000. For a place like India, you're looking at around about 6.5 times wealthier. For a place like India or Indonesia, around about 4 times wealthier. So the average person within these economies, as they grow, is getting wealthier, and they're moving up the consumption curve from just sort of plain foods and plain manufactured goods and simple manufactured goods. And you can see why there's such a strong demand for, say, New Zealand milk or Aussie beef, because as they get wealthier, they start to consume foodstuffs that perhaps they weren't able to afford previously. Now, I mentioned I was in Shanghai last week. I just want to highlight to you one company that is currently a large weighting within the Fidelity Global Emerging Markets Fund. You can actually buy this fund on the ASX. It has a ticker called FEMX. It's an active ETF. So this company is a company called Li-Ning. Who's familiar with the guy Li-Ning? The man Li-Ning? Few people. Li-Ning is the equivalent of Cathy Freeman. He lit the Olympic cauldron in the 2008 Olympics. He was China's first gold medalist in the Olympics in 1984. He won 3 golds, 2 silvers and a bronze, and he's known as the Prince of Gymnastics throughout China, household name. And in 1989, just as the Chinese economy was starting to open up to the rest of the world, and is continuing to do so in terms of economic liberalization, Li-Ning thought, I've retired from gymnastics, what am I going to do with the rest of my life? And he thought, wouldn't it be nice if the Chinese Olympic team one day wore a Chinese branded tracksuit in the opening ceremony of the Olympics rather than a Western brand like Nike or Reebok? So he started this company, sportswear manufacturer, and clothing and footwear. And what we really like about this company, again, it's really targeting the Chinese consumer. So it has 7,000 stores throughout mainland China, and its focus is on the real most popular sports within China. The first is running and walking. So the Chinese Communist Party have put health at the center of their plan out to 2030. So they're trying to encourage the local Chinese population to get healthier. The first thing you do is go out and buy a pair of shoes, and hopefully they're a pair of Li-Ning runners. The third most popular sport amongst millennials in China is badminton. So Li-Ning sponsors the top badminton players throughout China. They sponsor the Indian badminton team and top players within India and Indonesia. And they also sponsor the local Chinese Basketball Association and also prominent NBA athletes within the US NBA. So they sponsor a Hall of Fame or future Hall of Famer guy that used to play for the Miami Heat called Dwayne Wade, and they used to sponsor Shaquille O'Neal in the US as well. So this company, we think there's a lot of things to like about it, particularly as Chinese consumers get wealthier and they start to look increasingly at Chinese manufactured products, but also Chinese designed products that incorporate symbols such as Mandarin symbols or use the favorite colors such as red, for example. So last week I went and checked this out, and you can see me there in the Li-Ning store. So this is a brand new product line for Li-Ning, the more premium product line called China Li-Ning, which is targeting the ultra high net worth cohort of Chinese. So the Chinese middle class, the IMF estimates, is around 800 million people by 2022. And you can compare that to the total size of Australia's population of only 25 million. So it's a huge market, and they're focusing now on the ultra high net worth cohort. I went into this store and a jumper was around about the equivalent of $200. I've got young kids to feed, so I didn't buy one. But you can see the sort of growth profile of the share price that it's experienced over the course of the last year. And our analyst, based in Hong Kong, he thinks that we're seeing clear operational improvement on all fronts for this company, and he continues to expect further gains in the share price going forward. So this is just one of the companies within our portfolio in terms of global emerging markets that we really like, and we've been able to tap into that fantastic growth story. Now, I just want to highlight for you today the challenge that you face in terms of rock bottom low interest rates. These are our forward projections, 5 and 20 years, that come from London, our investment solutions design team. And the bars, the lines across the bars represent Australia inflation, which we estimate will be around about 2 to 3%, around about the RBA's target. But the light blue lines represent 5-year annual returns, and the dark blue lines represent 20-year annual returns for various asset classes. So if you invest in Aussie cash, global government bonds, global investment grade corporate bonds, you're likely to lose money in real terms over the course of the next 5 years because returns on those asset classes are depressed given where interest rates, global interest rates are today. You have to really look down the risk spectrum in order to start generating positive real returns. And in terms of emerging market equities, not unlike what Peter had just put up in terms of EM equity returns, we think it's going to be around about 6% per annum over the course of the next 5 years and over 7% per annum over the course of the next 20 years. So there's a very famous guy called Harry Markowitz who won a Nobel Prize in economics. He's known as the father of modern financial portfolio theory, and he said there's one free lunch you get in investing, and that's diversification. Well, I'm going to put myself up with a Nobel Prize winning economist. I'm also going to say there's another free lunch, and that's the length of time that you're investing. So a long-term structural allocation to EM equities over the course of the next decade and beyond, I think makes a lot of sense for most investors in this room. Now, I just want to highlight as well the challenge that many of us face today in terms of the official inflation number in Australia relative to the costs of needs versus wants. A very famous, thesis within economics. How do we fulfill our unlimited needs with only scarce resources? So you can see here, what I've done is look over the course of the last 19, 20 years, since the year 2000, and I've highlighted the rising costs of needs like school education, electricity bills, utilities, primary school education, insurance, and you can see the extent to which they've risen much faster than the official inflation number, much faster than wages, and equally, the things that are getting cheaper are the discretionary items, such as furniture, clothing, computers, and technology. It's not actually getting cheaper, it's just that the quality of those items are getting much better. So if you're looking at an asset class that's going to deliver above inflation returns, that might not be sufficient for you to continue to protect your standard of living. You might have to look at even higher returning growth assets if you're going to try and keep up with the increasing price of a category such as utilities, for example. And this is exactly what central banks want us to do. They want us to take more risk, they want us to borrow more, and they want us to move down the risk spectrum. Now, really quickly, the listed fund that I have available is an active ETF. It's called FEMX. One trade, you get access to all of Fidelity's resources and a professionally managed active portfolio, concentrated much like Magellan, currently around about 32, 33 stocks in this portfolio, active money. We suggest a longer term time horizon. I've got there 3 to 5 years, but the longer the better. And this is the performance that we've been able to generate since 2013 when we were running a pilot portfolio, and the launch of this fund in an unlisted format, unit trust format. The active ETF replicates this strategy. And you can focus there on the green numbers there in terms of our performance relative to our peer group. It's really been exceptional, really driven by the skill of the portfolio manager, backed up by the analyst team, and also the robustness of the investment process. And with that, I'm going to hand it back to Peter. I've gone over time as well, but I think the anecdote around the kids was worth it. Do you think, Peter?
Yeah, without doubt, it was good.
And I'm going to hand it back to him now. Thank you very much.
Thanks, mate.